Throughout the 1980s, Japan was the envy of every developed nation. Its GDP had grown at astronomical rates for decades, transforming a war-devastated country into the world's second-largest economy. Japanese companies like Sony, Toyota, and Mitsubishi were conquering global markets. Real estate in Tokyo became so valuable that the grounds of the Imperial Palace were theoretically worth more than all of California. The Nikkei stock index reached nearly 39,000 points in December 1989, and Japan's per capita GDP was on track to surpass that of the United States. Business schools around the world taught Japanese management techniques, and books predicting Japan would become the world's dominant economic superpower filled bestseller lists. But then, almost overnight, everything changed. The turning point came in 1990 when the asset price bubble that had been inflating throughout the 1980s finally burst. The Bank of Japan, worried about runaway speculation and inflation, had begun raising interest rates in 1989, tightening monetary policy to cool down the overheated economy. What followed was catastrophic. Stock prices plummeted, losing nearly half their value within months. Real estate prices, which had reached absurd heights, began a long grinding decline that would eventually see property values fall by over 60% in some areas. Banks, which had loaned enormous sums of money using overvalued real estate as collateral, suddenly found themselves holding worthless assets. Companies that had borrowed heavily to invest in expansion and stock market speculation saw their balance sheets implode. The financial system, once the pride of Japan's economic model, became riddled with bad loans that banks couldn't write off without admitting insolvency. But the bubble bursting alone doesn't explain why Japan never recovered. After all, many countries experience financial crises and bounce back within a few years. The United States had the savings and loan crisis around the same time and recovered relatively quickly. What made Japan different was the response, or rather, the lack of an adequate response. The Japanese government and central bank were paralyzed by a combination of cultural factors, policy mistakes, and structural problems that turned what should have been a severe recession into 3 decades of stagnation. Banks, rather than admitting their losses and restructuring, engaged in what economists call evergreening of loans, essentially rolling over bad debts to avoid recognizing them. They kept lending to insolvent companies, creating an army of what became known as zombie companies that couldn't grow or innovate but couldn't be allowed to fail either because their collapse would expose the true extent of bank losses. The demographic time bomb that had been ticking quietly in the background suddenly became impossible to ignore. Japan's population had been aging rapidly, and the working-age population peaked around 1995 and began declining. This created a vicious cycle where fewer workers meant less consumption, less innovation, and a greater burden of caring for the elderly. Young people, witnessing the economic collapse and seeing their parents' generation struggle, became incredibly risk-averse. The traditional Japanese employment system of lifetime employment at a single company became both a blessing and a curse. While it provided stability, it also meant that failed companies kept their workers on payrolls they couldn't afford, draining resources that could have been used for innovation or expansion. Young people who graduated during the recession faced a labor market where companies weren't hiring, creating a lost generation whose career prospects were permanently damaged. Deflation became the silent killer of the Japanese economy, a phenomenon that most Western economists had only read about in history books about the Great Depression. As prices began falling in the mid-1990s, a deflationary spiral took hold. When people expect prices to be lower tomorrow than they are today, they delay purchases, reducing demand, which causes prices to fall further, which encourages more waiting. For businesses, deflation meant that revenues were constantly shrinking in nominal terms, even if they were selling the same amount of goods. More insidiously, deflation increased the real value of debt. Companies and individuals who had borrowed money during the bubble years found that the yen they had to pay back was worth more than the yen they had borrowed, making debt burdens increasingly unbearable. The Bank of Japan cut interest rates to zero by 1999, but even zero interest rates couldn't spur borrowing and spending when people expected prices to keep falling and when the banking system was too damaged to effectively transmit monetary policy. The government tried stimulus after stimulus, implementing one of the most aggressive fiscal expansion programs in modern history. Japan built roads, bridges, airports, and public works projects across the country, running up enormous budget deficits that pushed public debt to levels exceeding 200% of GDP, among the highest in the developed world. Yet these stimulus programs had diminishing returns. Much of the money went to politically connected construction companies working on projects in rural areas where population was declining, essentially building infrastructure that nobody needed or used. Critics called it digging holes and filling them in again, economically unproductive activity that created short-term jobs but no lasting growth. The Keynesian multiplier effect that should have amplified the government spending into broader economic growth simply didn't materialize at the expected levels. Cultural factors played an underappreciated role in prolonging the stagnation. Japanese society's emphasis on consensus and avoiding confrontation meant that painful structural reforms were constantly delayed. Banks weren't forced to recognize losses and recapitalize. Inefficient companies weren't allowed to fail. Workers weren't laid off even when businesses couldn't afford them. The social contract that had served Japan so well during its growth years became a straitjacket during the bust. There was a pervasive sense of shame about the economic failure that made it politically difficult for leaders to acknowledge the true depth of the problems. Rather than the creative destruction that Joseph Schumpeter identified as essential to capitalism, where failing businesses are replaced by new, innovative ones, Japan preserved the old structures at all costs. This meant that capital and labor remained trapped in unproductive uses, instead of being reallocated to more promising sectors. The global context also shifted in ways that hurt Japan's traditional economic model. China's rise as the manufacturing powerhouse of Asia meant that Japan faced intense competition in precisely the sectors where it had dominated. The export-led growth strategy that had worked so well when Japan was the low-cost, high-quality producer became less effective when Chinese factories could produce similar goods at a fraction of the cost. South Korea and Taiwan also emerged as formidable competitors in electronics and other high-tech industries. Meanwhile, Japan was slow to adapt to the digital revolution. While American companies were creating the internet economy and transforming industries through software and services, Japanese companies remained focused on hardware manufacturing. The keiretsu system, where networks of companies held cross-shareholdings and maintained long-term relationships, made it difficult for new entrepreneurs to break into markets and fostered a risk-averse business culture that avoided the kind of disruptive innovation that was transforming Silicon Valley. The policy response oscillated between stimulus and austerity in ways that may have made things worse. Just when the economy seemed to be recovering slightly, the government would implement tax increases to try to address the growing public debt, pushing the economy back into recession. This happened most notably in 1997, when a consumption tax increase coincided with the Asian financial crisis, sending Japan into a severe downturn. The Bank of Japan, despite eventually pioneering unconventional monetary policies like quantitative easing that would later be copied by other central banks, was often behind the curve, raising rates prematurely or not being aggressive enough with its asset purchases. There was constant tension between those who wanted to maintain fiscal discipline and those who argued that the economy needed continued support, resulting in a muddled middle path that satisfied neither objective. Looking at Japan's lost decades 3 decades later, what's striking is not just the economic stagnation, but the social and psychological toll it has taken. A generation of young people grew up without ever experiencing economic optimism. Marriage rates fell and birth rates plummeted as young people delayed or avoided family formation because they couldn't afford it or didn't feel secure enough in their prospects. The hikikomori phenomenon emerged, where hundreds of thousands of people, mostly young men, withdrew from society entirely, living as shut-ins. Consumer confidence remained perpetually depressed. The energetic, ambitious Japan of the 1980s gave way to a cautious, pessimistic society. Yet life in Japan didn't collapse into misery. Unemployment remained relatively low by Western standards, crime rates stayed among the lowest in the world, and the social fabric held together. Japan's experience showed that a wealthy society could stagnate economically while still maintaining social cohesion and relatively high living standards, though at the cost of dynamism and opportunity.